Okay, close enough. Let's get started. Uh, just quick housekeeping items. If you do have a question, it should be on the bottom of your Zoom. You see a little hand that you can just raise your hand. I'll be able to click on you and you'll be able to talk into Zoom. And any questions throughout the presentation, raise your hand at any time. Easy to stop and answer your questions. But obviously, like all the other presentations, if you have any questions after the fact, shoot me an email, give me a call. Happy to jump on a 5, 10-minute, 15-minute call. If you have any particular details you want to dive in on. Tonight's topic, long-term care. Probably one of my least favorite topics. It's as a planner, what I'm always trying to do is figure out the combination of probability, determine how catastrophic is it, what resources do we have at our disposal, and finding out where is that middle spot that makes the most sense based on those three categories, which isn't always easy. And sadly, when it comes to things like long-term care, the planning that you can utilize to put in place sometimes has to be put in place 10, 20, 30 years before you ended up going to use a particular policy. So it's a rather frustrating donut hole, not only on the individual level, but nationally as well. I didn't plan on bringing this into the conversation, but our country is struggling a little bit. The reason for that is Social Security, Medicare, and Medicaid. This donut hole to pay for care for people older than 65 is a very hard riddle to figure out, like I said, on a personal level and on a government level. My goal tonight is to educate the basics on how life insurance work that has a long-term care rider, how a typical long-term care insurance policy works, as well as the 5 or 6 things I think about before making a decision. Of really, the decision comes down to 4 categories. 1, traditional long-term care insurance. 2, some sort of hybrid policy that incorporates life insurance and long-term care together. 3, utilizing an elder care attorney. Or 4, more or less letting it ride and just kind of self-insuring and a little bit of a hope for the best. In a lot of situations, that's the best case. So I'm not trying to poo-poo that scenario. So I'm going to go over the 5 or 6 things that are the factors in those scenarios, which kind of put you in one of those 4 buckets. So what is a long-term care event? So long-term care when it comes to long-term care insurance is you can't do 2 of the 6 activities of daily living, such as your basic stuff. You can't feed yourself, bathe yourself, transport yourself inside and out of bed. Your mental faculties kind of being reduced. Those are the things that would trigger a typical long-term care event. Now, obviously, we know when those situations present itself, it's typically not cheap to deal with that reality. It doesn't really make a difference if you're looking for care at home, care in an assisted living facility, in a nursing home. These are 6-figure problems sometimes. So it's certainly not something we can ignore. My goal for this, as well as everything that I do, is simply educate yourself on your options, educate yourself on the probability, as well as not only what is the highest probability of playing out, but if good or bad plays out, how catastrophic is the particular situation. Now, there is a lot of doom and gloom when it comes to long-term care. And, one of the aha moments that I personally had as I'm kind of researching the subject, and I'll share my screen, was a piece that came from Vanguard. And it helped me really frame how I look at long-term care. So this is a slide breaking down statistics of if someone has a long-term care event, and then typically how costly is this long-term care event. Now, I think this is a few years old, so I'd skew everything up a little bit in terms of cost, but the concept is the same. So to me, there's a few buckets that I'm seeing here. One, more or less, is a coin flip. whether you're going to have a situation where you have a dramatic increase in cost to deal with a long-term care event. Sometimes you might be fortunate, I say fortunately, but some people just go to sleep and don't wake up one day, had zero long-term care costs associated with them. Some people might be in a assisted living facility for 5-6 years. Now, what that chart goes over, it kind of breaks you down into probability. So, all right, so we know 50% of the time didn't happen for you. Now, I would say an additional, let's call it 25%, just to kind of use round areas, that, yeah, you had a long-term care event, but it was relatively quick. So it only cost you, let's say, 100 grand or less. So that's not a situation where you're going to wish you had long-term care insurance. Between the cost of it and the elimination period, which I'll go over, it just would have made more sense to self-insure. It's really the scenarios where it's costing you 100 grand, 200 grand, 300 grand, which probably are in the 20 to 25% scenarios. Now, 20-25% of the time where it's really catastrophic to your family is a probability that's pretty high. And it's a risk, like I said, we can't ignore. As long as we address it and we figure out what makes the most sense, we're always going to hope for the best. There's always a probability that life doesn't come our way, but did we make the best decision with the information we had at the time? So just to recap, long-term care can't do 2 to 6 activities of daily living would trigger a long-term care policy or a life insurance policy with a long-term care rider. As we all know, if you have to go into an assisted living facility, especially in the New Jersey, New York, Connecticut area, it'd be $10,000, $15,000 a month, which is no joke. But statistically, 90% of the time, it's like 3 years or less that you're, once you get to the point where you need care, that how long you're lasting. Now, it's very hard to plan for that last 10%. And a lot of time where you're planning for a 4, 5, 6 year, the cost of the policy is just through the roof. So you almost have to just play for base case scenarios, take catastrophe off the table, which I'll explain how to do that, and a little bit of hope for the best. So an example of this is my own personal situation with my own mother. So my mom, a few hundred grand to her name, nothing crazy, nothing over the top. Now, as her son, we're in a reality where everyone on this call is part of the baby boomers. So there's a lot of you, and there's only a limited spaces for these healthcare. And I almost look at it as like your golden ticket to get a bed in one of these facilities. So what they're certainly going to look for is the ability to pay for at least 2 years. If you can't self-insure for at least 2 years by the combination of a long-term care policy, possible life insurance policy, or cash, they don't really want to look at you, because they don't want you to go on Medicaid quickly, because they're getting pennies on the dollar of what they normally would for that you're more or less your room. So when it came to my mom's situation, all right, we have limited resources, but I need to take catastrophe off the table. So what I did was I didn't get all your bells and whistle long-term care policy. I got a better than nothing long-term care policy. So I'm going to pause right here, and I'm going to dive into how a long-term care policy works. So let me share my screen. Now, don't get caught up in the figures. It's more the concepts I'm going to land. If you're just curious, hey, what are the costs for me personally? I can easily have numbers run, but this is just the concepts I'm really just trying to ingrain. So there's only 4 or 5 insurance companies out there that really still offer long-term care, and it's a tough reality. It's one of the worst types of policies to have, but it might be the best of all that we have available to us. And what I mean by that is, with let's say a whole life insurance, what your premium is going to be, what your death benefit is going to be, pretty well how the cash value is going to grow. Everything's kind of fixed. With a long-term care policy, you get to pick what your numbers are in terms of your pool of money, your inflation, but it starts out with a premium, but in the future they can raise the premium not for yourself as an individually, but for a whole class. So for example, on my mom's policy, which we've had for about 10 years, I think they raised it once, but that was about an 18% increase. So what we're looking at here, like I said, is a long-term care policy, which you can buy individually or as a husband or family unit. So how it works, and my mom's is pretty similar to this. I'm trying to address the high probability scenario. So like I said, high probability is 3 years or less. So this is a 36 months or 3-year policy, in which case the pool of money that one would start out with is 180 grand, and that allows you to tap $5,000 a month. Now, there is also an elimination period where you can do 90 days, 6 months, or 1 year. Your 1 year and 6 months are going to be much cheaper, but it probably is not worth going down that path. If you are going to do a long-term care policy, I would try and push people to 90 days because the costs get up pretty quickly. And then you could also put an inflation rider. I would almost always put an inflation rider on there. It is an expensive rider. So that what that means is this pool of money of 180,000 might be growing at, if you pick 3% or 4% or 5%. So where I wouldn't, maybe if you were getting a long-term care policy a little bit later in life, a little bit later would be 67, 68, 69, maybe 70. Past then, just the cost gets astronomical. But then you're maybe close enough to the long-term care event where I might say, all right, don't put it on there. But if you're 65 or younger and you're in your 50s and you're buying one, that long-term care rider is very important. So again, we're figuring out the pool of money. Now, the way I kind of break into it is multiple parts. So let's say my mom needed to go into an assisted living facility that cost $10,000 a year. Okay, well, my mom did a good job in her situation. Well, we had my father passed away a little bit younger, so we used the widower Social Security benefit to allow her to grow. So she flipped hers over at age 70. So she's getting about $3,200 a month from Social Security. All right. Now this policy here would pay $5,000 a month. All right. So we got 5,000 plus 3,200, plus we have a little bit of resources that might be able to produce 1,000 to 2,000 a month. All right. If I have to come out of pocket an extra 1,000 or 2,000, that's livable. That's not catastrophic to me or to her. So by buying this policy that really wasn't designed to pay the entire nut, it was just to, if I had to come up with $7 grand a year, that might be catastrophic for me or for my family. So if I have to come up with $2 grand, that's manageable. So my goal is to take risk of catastrophe off the table. So again, just to recap, we're buying a pool of money that's capped with a monthly rate most of the time. So in this situation, $5,000 times 36 months, that's the 108,000 pool. We could use it in an assisted living facility or at home. Some policies, every company has their own little shtick of, hey, they got this little feature or that little feature. There's, if most of them are now reimbursements. So you show, hey, here's my skilled nursing bill, reimburse me for the cost. Some say, oh, if I don't want to give you proof of receipts or invoices, you can just say, just give me cash at a fraction of the amount. But like this way, it'd be good if you're using to pay someone under the table or something like that. Now, premiums for if someone's around 60 for a couple for a worthwhile policy with an inflation rider, it might be $4 grand a year, $5 grand a year. It all depends on a few of things that I'm going to go over towards the end of this presentation on what's important to you, or in terms of inheritance, and do we have enough resources if one person exhausts all the assets and the other person ends up living for an extra 15 years, what happens? Do we have enough money? This is why, like I said, I don't like long-term care, because you're not locked into premiums. They can adjust things. They can force you to tweak down your benefits, but it might be a necessary evil if, we can't have a scenario where 25% probability that second person might be kind of screwed and run out of money. So again, I just wanted to kind of give you basics of how a long-term care policy work. and just go a few over the features of it. Now, why it's important, like I said, with the long-term care inflation riders, it makes a big difference. You know, because odds are, let's say you got the policy around 60, so your pool of money is around 180 grand. Well, that pool of money is now 365,000, probably when you're going to need it. So, you know, if inflation, and that's using a 3% inflation. You know, inflation, especially for healthcare, is 5-6%, and that's over the last 10-15 years where normal inflation has been lower. So if you are going to get a long-term care policy, having one with an inflation rider probably makes a lot of sense. Oops, sorry. Now, in the last 5 years or so, they have been rolling out a lot of life insurance policies with long-term care riders. Now, what we're looking at here is actually the one I have for my wife. You know, with planning, just like with retirement, the earlier you plan for something, the easier it is to deal with it. So the one I currently am showing you here is by American General, or AIG. It's a rather unique policy. Most of them, you can get 3 features. This one actually has a 4th. So I'm going to go over those features. So what we're looking at here is I have to pay over 20 years, $5,000 a year. After that, I'm done paying it. So what I like about this is there is no wiggle room. There is no, they can do this or this. It's contract. So I give them 100 grand over the course of 20 years, and I'm done paying for it. Now, this has a life insurance feature that would pay 650 grand. All right, that's pretty good. That's 6.5 times leverage for my money. Now, you know, a hidden thing that a lot of people don't think about is 40% of all long-term care events happen before 65. You know, God forbid my wife gets in a car accident or something like that, or you just never know. So, you know, I always like to make sure people either have long-term disability insurance or having something like this of, if catastrophe plays out, you know, we'll be fine. We'll figure out a way of making do. So like I said, this policy pays, put in 100 grand, you have $650,000 of death benefit for the rest of your life. They have a return of premium feature. If for whatever reason, I don't want to keep the policy now, you almost never would do this, but you know, after 20 years, you can get 50 grand back. After 25 years, you can get 100% of your premium payments back. Now, again, you probably never exercise those options, but can't hurt that they're there. So like I said, that's your conventional life insurance. Now on the, that's bucket A. You know, in this situation, the worst part about long-term care is you pay into it for 25 years and you never needed it. That's where people get frustrated with insurance, and I get it. So you're always going to utilize one with a life insurance. So if you use it for a death benefit purpose, beautiful, it's 650,000. If you do have a long-term care event, they allow you to take it out over 5 years. So I could take out 131,000 a year to help pay for the costs of the long-term care, tax-free. Or third, let's say, and this is the feature that you don't typically see, you could actually take it out as a retirement income piece. So what's interesting is this column here. So let's say you end up spending too much money too early in life. They allow you to take all of the death benefit out as a retirement income play. So as we sit here, we say, all right, well, I don't need it. Beautiful. Then it's just life insurance for the kids. All right, I have a long-term care event. Great. Now I get to leverage my money. Since I put in 100 grand, I'm going to get a $650,000 pool, and I'll use it for long-term care insurance. Oh, I didn't have a long-term care event, but we didn't plan our retirement. Great. Now I can take the death benefit out and use it as a retirement income play over the course of 10 years. So that last feature I've never seen on a life insurance policy before, and very unique. Now, again, I'm fortunate enough to be in the industry I am, to have the cash flow for this at a young age. And big difference is we got preferred best, which is the highest possible health class. So certainly your health in getting policies is a tremendous factor, but there is still policies worthwhile in the life insurance long-term care hybrid reality for people in their 50s and 60s. So it is a path you can take, and in some situation makes a lot of sense. So let me pause there, stop sharing my screen. So just to recap, so we have, as I sit down with someone who's, let's say, 65 years old and it's a couple, and I'm trying to figure out what makes the most sense. All right, we have the conventional long-term care. We have the life insurance with the long-term care rider. We have the ability to just self-insure. And then 4, we can also utilize an elder care attorney to help protect our assets. So let's take a few minutes and go over the elder care route. So most of the time, if you're going to look to protect your assets, you have to accomplish a couple things. Like I mentioned before, you almost need your ticket to get into an assisted living facility. What they're looking for is at least 2 years the ability to self-pay. So what you can't do is, oh, I put all my money and locked it up in trust so they can't get access. Great, they're not going to let you in. And it's become very hard to be able to utilize an assisted living facility. So you almost have to have your sacrificial sum of money that you leave outside of it, and then you could protect your assets in a trust. Now, you can't put IRA money, you can't put 401k money. So a lot of times you're like, oh, I'm going to go that route. Well, if you're really top heavy and all your money's in retirement accounts, can't utilize it. This is very well designed for real estate, for after-tax money, for money in the bank. Those are things you can really protect. A lot of times I've seen a situation where people are cashing in retirement accounts, paying big taxes to try and protect it, which may or may not make sense. But what you're doing, utilizing an elder care attorney, is putting things into an irrevocable trust. So it's not the government can't get out of it, assisted living facilities can't get out of it. And conceptually, you can't either. Now, a lot of times the trustee of this trust might be your kids, your brother, your sister, in through certain back doors, you could probably get access to money. But you're locking the money up. Now, this money is its own tax entity and has to file its own tax return. So what a lot of these are designed to, and you can't benefit and you can't have any tax ramifications of these trusts, is there is a lifetime beneficiary. So the lifetime beneficiary has to deal with the taxes. So money goes into the trust is trying to grow, getting paid interest and dividends, what we got to pay taxes on. That tax obligation would flow onto a lifetime beneficiary, and they put that on their personal tax return. So it's not easy, it's not fun, there's a lot of moving parts, you got to deal with it every single year. Because a lot of people just think, oh, I'm not going to do the life or long-term care route, I'm just going to put it in trust and I'll protect everything. It's not that simple. They're annoying, and they're expensive to put into place. A lot of time, maybe $7,000, $8,000, $9,000, $10,000 to put in place, but a lot of time it does make a lot of sense. Because what you're saying is, all right, I'll put 10 grand here, but I might be protecting $500,000 or $1 million. So it's certainly a tool that we utilize sometimes. So we got our life insurance, we got our long-term care, we have our elder care attorney, and then we have self-insure. So as I'm sitting down with someone and we're trying to figure out which of those 4 make the most sense, there's a few factors that I'm mentally going over to steer us in one way or direction. Most of the time, and pretty much everyone on this call, I can tell you what to do off the top of my head, because a lot of times, just to briefly go over the different things that I factor into. One, what are your inheritance goals? Because what you're really doing with, let's say, a long-term care policy is buying a pool of money to protect this pool of money, either for a spouse or for the next generation. So how much you care to make sure that protection is put in place is going to cost you. So I give the example of, all right, in either situation of a life insurance or a long-term care insurance, let's say your budget in retirement is 100 grand. What you're saying is, it's important for me to preserve, I'm going to make up a number, 300,000 for my spouse or 300,000 for my kids. So what I'm going to do is I'm going to pay a premium to purchase an insurance policy So instead of my budget being 100 grand, premium to say 3 grand, I have the privilege of spending 97 grand because I need to make sure that that pool of money is protected. That's what you're really doing. You're going to sacrifice a little bit of your budget to make sure the next generation, or a really bad scenario plays out, that the spouse is protected. So as we're factoring in long-term care, what is your inheritance goals? Do we have a spouse that we need to be concerned with? What are your other assets? What are your other income? What's the cost of the policies that we'll be putting in place? What's your age and what's your health? Like a lot of times if someone's in bad health, beautiful, we can knock 2 off the table and now we're just dealing with 2. Most of the time when you factor in someone's age, your health, your income, your cost, your spousal goals, most of the time there's really one choice that makes the most sense. This is why I made the comment of most of the time, pretty quickly, I can tell you exactly what makes the most sense. Just to dive into this and a few of the points is, I'm truly a believer, if you're going to go the long-term care route, you want to be probably around 60 years old. I wouldn't utilize a long-term care policy if you have assets of $250,000 or less. You're probably just going to go on Medicaid, and the cost is going to be so prohibitive. It's going to eat so much into your budget that it's just not going to make sense. At the flip side of that, if you're north of 2.5 million of a net worth, and that assuming you don't have any pensions, I would say I would self-insure the risk. Because again, going back to that probability I showed you from the Vanguard study, half the time you don't have a long-term care event. Of the remaining half the time you're spending 100 grand or less. So just based on probability and your assets, I would self-insure the risk. The life insurance card, if that's the scenario where inheritance is a big concern, as well as spousal protection is where you would really want to put that in place. Like all insurances, the older you get and the worse health you get, you're probably going to get away from that because you're not going to get a return on investment. Like I showed you the one policy for my wife, we're able to get 6.5 times leverage of our money because we started when she was 30. So, a lot of times when you're looking at those types of policies, whether it's life or long-term care, and you're in your 60s, you might not be in the greatest, not horrible health, but not in the greatest of health, and you might get the health class as standard. A lot of times it doesn't make a lot of sense. So it's not every day that I recommend the life insurance route or the long-term care. There's certain situations where I say, well, if that event plays out, it really is going to be catastrophic for the other person in the relationship. We have to deal with that risk. If you're single and you don't have kids, and you have at least a few $100 grand, I would say buy nothing. Like I said, as long as you can cover yourself for a year or 2, assisted living facilities would be fine. And, plus you have your Social Security. So don't make that deal. So I wouldn't be buying this really if a spouse wasn't a concern or kids weren't a concern. The assets are a big one when it comes down to whether you can really use an elder care attorney. The conversation for that is somewhere in the 72 to 75, because, a Medicaid look back is 5 years. So sadly, what a lot of people do is they want to start doing planning when, mom has to go into a assisted living facility. The day to do planning is when you're got everything about you and have a few years before that's even consideration. So that's why I tend to early to mid 70s is when you want to start looking into, if that makes sense for you. Like I mentioned before, if you're really top heavy in IRA and 401k money, you're not really going to be able to protect it. But you can certainly protect your family home, rental properties. You can protect, cash and after-tax money without a doubt. It is going to take someone other than yourselves to be a big part of the equation, because like I said, when you put money into trust, the taxable portion of the trust gets pushed onto the living beneficiary. It's most of the time is the trustee, so it impacts their tax returns. There's just a bunch of moving parts. So it sometimes makes a lot of sense but it's not an easy path. And the hesitation you have in my voice is the reality I said at the very beginning. This is a hard one when it comes to planning one's retirement, because there's a bunch of variables that we don't know. And the more variables you have in an equation, it's harder to find the perfect answer. But like I said, most of the time when I address those 6 things, what's the person's health, what's their age, what's their cost, the cost of the insurances, what does your income look like, what does your assets look like, what type of spousal planning we have to do, and what type of inheritance planning to do. When you factor all those in, normally one of those 4 options becomes pretty clear as the best case scenario, or the scenario that has the highest probability of giving you success. It doesn't mean life's going to play out that way, but all we're ever trying to do when it comes to retirement planning is figure out what is the highest probability, understanding the tail risk of things going right or wrong in either direction, and doing as best as you can, because you're not going to be perfect, because the perfect long-term care policy that protects 99.9% of scenarios might cost 15 grand a year, and no one's going to ever sign up for it. And a lot of times, like I mentioned before, with my own personal mom situation, you might be getting a better than nothing policy, and it's just to help take the edge off if the event plays out. So I do utilize those sometimes. It's very rare that I really utilize a very robust life insurance or a long-term care policy recommendation. Normally it's a little bit of we'll utilize some assets, we'll utilize some income, we'll utilize some insurance, and that hybrid kind of hedges our bet normally on whatever scenario kind of plays out. Those are really the important takeaways that I want everyone to have, is those 6 scenarios I think about, the 4 routes you can go, the probability of things playing out. And like I mentioned at the very beginning, I'm happy to sit down with you and give you my thoughts on your own personal situation, what makes the most sense. As long as you're doing what you're doing right now, educating yourself on your options and making educated decisions, that's all you can ever do. A lot of people sadly put their head in the sand, they wake up and, all right, we have an assisted living facility scenario and we can't really plan anything. And now we more or less got to burn money. But the earlier you plan, the better off you're going to be. Like I said, I put my wife's policy in place when she was 30 years old. Hopefully I never need it, but this is the point of insurance. So I'll pause here to see if there's any questions. Okay, guys. Well, as always, it was a pleasure. Thank you so much for joining me. If you have any follow-up questions, shoot me an email, give me a call. Happy to run any scenario that you're curious about. Thanks and have a great night.